Welcome. In this module, we'll shuffle through the complexities of equity risk analysis and valuation frameworks, making sense of models like DCF and GCM.
Welcome to The Explainer. Today, we're diving straight into a real-world market mystery, reverse engineering exactly how stock risk works. We're completely bypassing the dry textbooks and looking at actual real-time market behavior to understand the true mechanics of equity risk. So let's just get right into it. Think about the market over the last couple of years, right? Especially during periods of global economic uncertainty, like when central banks were aggressively hiking interest rates. You've probably noticed a glaring pattern. Electric vehicle stocks, like Tesla, were on an absolute roller coaster. I mean, swinging up 10% one week and crashing down 15% the next. Meanwhile, established information technology stocks, they barely flinched. They just get chugging along. So why? What invisible forces are actually dictating this radically different behavior? Well, to answer that, we really have to look at their foundational business models. On one side, we've got the EV industry, the wild innovator. Companies here are dealing with rapid, disruptive innovation, completely uncertain consumer demand, and constantly shifting government regulations. It's a lot. Then, on the other side, we have the IT industry, the steady worker. Companies like Infosys rely on stable revenue generated from multi-year, long-term contracts. Their earnings are, frankly, highly predictable. And as we're going to see, this fundamental difference in predictability is the exact engine driving equity risk. Here's our roadmap for today's explainer. First, the IT versus EV divide. Second, defining equity risk. Third, measuring stock volatility. Fourth, the risk-return trade-off. And fifth, traps and pro tips. Starting off with Section 1, the IT versus EV divide, a real-time industry case study. What's absolutely fascinating here is the sheer scale of the difference. When we chart out historical volatility, the visual proof is undeniable. Just look at the IT sector bar sitting there calmly at a really low level. During times of economic stress, IT firms experienced significantly lower drawdowns. But then, look at the EV sector bar. It's practically double the height. These companies went through massive, stomach-churning price swings, defined by super sharp rallies followed by equally sharp falls. The data proves that the roller coaster feeling, it isn't just an illusion, it's a mathematically measurable reality. So the absolutely crucial point here is this. Same market, different industries equals completely different risk profiles. Both sectors were swimming in the exact same macroeconomic waters, right? They faced the same inflation, the same interest rate hikes, the same geopolitical news. But because their underlying business models, industry cycles, and growth uncertainties are vastly different, they reacted in completely divergent ways. Moving on to Section 2, defining equity risk, which is about way more than just losing money. Now, this definition is where we need to correct a massive beginner misconception. When most people hear the word risk, they immediately think, losing money. But in equity analysis, risk is the uncertainty and variability about the future returns of a stock. It's all about dispersion. Think about it. If a stock goes up 50% in a single year, that is actually still considered highly risky behavior because it represents extreme variability and uncertainty. Risk isn't just about the downside. It's about literally not knowing exactly what the future holds in either direction. To really wrap our heads around equity risk, we have to split it into two primary categories. First up is systematic risk. You can kind of think of this as the weather. It's market-wide, it affects everyone, and it absolutely cannot be diversified away. We're talking about inflation, interest rate hikes, or a global recession. Then, second is unsystematic risk. This one is company-specific. So if an EV startup's new battery catches fire or an IT firm's CEO suddenly resigns, well, that only affects that specific company. And that brings us to the golden rule of investing. Diversification removes unsystematic risk, not systematic risk. This is huge. If you own 30 different stocks across 30 different industries, a product failure at one EV company isn't going to tank your portfolio. You've successfully diversified away that unsystematic risk. But if a global recession hits, honestly, it doesn't matter how diversified you are. The whole market is going down. You are always left with that underlying systematic risk. Okay, Section 3, measuring stock volatility. Let's look at the core CFA tools. The first tool is standard deviation, represented by the Greek letter sigma. Look, you don't need to memorize the complex formula behind it to understand its power. Standard deviation basically measures the total risk of a stock, so that's both systematic and unsystematic combined. It calculates exactly how far a stock's actual returns deviate from its average historical return. A higher standard deviation simply means higher total risk, and this metric perfectly captures the wild, unpredictable ride of an EV stock compared to the tight, highly predictable grouping of an IT stock's returns. This second, and honestly perhaps the most vital tool, is beta. While standard deviation measures total risk, beta isolates systematic risk. It shows how much a stock moves relative to the broader market. If a stock has a beta of exactly 1, it moves perfectly in sync with the market. Market goes up 10%, the stock goes up 10%. But look at the EV sector. It typically has a beta greater than 1. If the market sneezes, the EV sector catches a cold. It is inherently way more volatile. Conversely, our IT sector, with all those steady contracts, has a beta of less than 1. It's less volatile and actually acts kind of like a stabilizer during market turbulence. Which brings us to Section 4, the risk-return trade-off, or the price of volatility. All of this naturally leads us to a pretty obvious question. If IT stocks are so much safer and less volatile, why would anyone ever put their hard-earned money into a highly unpredictable EV stock? Well, the answer lies in the Capital Asset Pricing Model, or CAPM. Again, look past the math here to the underlying logic. CAPM tells us the expected return of an investment. It essentially says that an investor requires a baseline risk-free rate of return plus a premium for taking on extra risk. And what dictates that extra risk? Beta. The formula mathematically proves that a higher beta dictates a higher expected return. You absolutely must be compensated with the potential for massive gains if you're willingly going to take on that huge EV-level volatility. But high returns don't actually mean much if the risk taken was downright reckless. That's exactly where the Sharpe ratio comes in. It's a totally critical metric that measures your return per unit of risk. It takes the return you made, subtracts the risk-free rate, and divides it all by the standard deviation. It's basically the ultimate reality check. It tells an analyst, sure, okay, that EV stock doubled in value, but given the insane volatility you endured to get there, was it actually a smart, risk-adjusted investment? This is hands down the most important question any investor or analyst must ask themselves, and it's a huge recurring motif in finance. Am I getting paid for this risk? If you're buying a high beta, highly volatile stock, the potential reward better be substantial enough to justify the stomach-churning ride. If it isn't, you're just taking on uncompensated risk, which, let's be real, is a fast track to destroying a portfolio. Finally, Section 5, Traps and Pro Tips. Let's get into some CFA Level 1 exam insights. Let's translate all this theory into actual practical application. Novice analysts fall into these common traps all the time. First, thinking that a high historical return automatically makes an asset safe. It's usually the exact opposite, right? High returns often mask immense risk. Second, analyzing a stock in a complete vacuum and ignoring the specific industry factors, like we did with our EV and IT comparison earlier. Third, confusing volatility with guaranteed loss. Remember, volatility just means uncertainty in both directions. And finally, ignoring the power of diversification to completely wipe out unsystematic risk. On the flip side, here are some pro tips to ensure you walk away with real actionable strategies. Always link your analysis in a chain. Industry dictates risk, which dictates expected return. Drill this into your head. Beta equals market risk. Standard deviation equals total risk. When evaluating a company, always apply real-world logic before you even look at a spreadsheet. Ask yourself, is this business predictable? If the answer is no, the risk is high. And finally, practice your CAPM calculations. It is literally the bedrock of modern finance. Let's do a really quick knowledge check straight from the concepts we've covered today. Which company is likely to have a higher beta? Is it A, a utility company, B, an IT services company, C, an EV startup, or D, an FMCG or fast-moving consumer goods firm? Take a second to really think about the predictability of their underlying business models. And the answer is C, the electric vehicle startup. By now, the logic here should be crystal clear. Disruptive, totally unpredictable industries with uncertain consumer demand and shifting regulations naturally carry higher systematic risk. Therefore, they inherently possess higher betas than companies selling electricity, long-term software contracts, or, toothpaste. I want to leave you with this final, really powerful thought. Risk in equity is not about avoiding uncertainty. It's about understanding which risks you're taking and whether you're being rewarded for them. So take a hard look at your own investments today. Are you holding a portfolio of steady IT workers or wild EV innovators? And more importantly, do your returns actually justify the roller coaster you're riding? Thanks so much for joining me on this explainer. Keep analyzing, and I'll see you next time.